So here's a question that almost never gets a straight answer. When a government decides to raise taxes, does that actually make your life more expensive? Okay, so most people assume that the answer is obviously yes, but the reality is a lot more nuanced than that. And honestly, depending on your perspective on finance and business, it can actually seem quite a bit more interesting. But depending on which tax actually gets raised and who it's raised on, the ripple effects through the economy are completely different. My name is Richard and welcome to Ronc Industries, the industry blog for investors and business, where we're pro-wealth, pro-growth and pro-business. Today we're going to pull this apart, one tax at a time. We're going to look at some simulated numbers run through a simplified business model, and by the end of this video, you're going to understand exactly how a decision made in a government budget meeting ends up or maybe doesn't end up in your shopping trolley. So let's get into it. So to understand why this conversation is even happening, we need to set the scene. Governments spend money, usually more than they collect. And that gap, that deficit, has to be closed somehow. Now take the United Kingdom as a recent example. Over the last 10 financial years, the numbers haven't been pretty. Back in 2014 to 2015, the UK spent around about £780 billion, collected roughly 670 billion in revenue, leaving a deficit of around about 16.5%. Now that's not great, but potentially manageable. Now, fast forward through the pandemic years and the picture gets significantly worse. In 2020 and 2021, spending ballooned out to 1.1 trillion pounds, while revenue sat at 800 billion. Now that's a deficit of 37.5%. By 2023-24, we're looking at spending of 1.3 trillion pounds against a revenue of 1 trillion, a 30% deficit. Now over the full 10-year period, total spending has hit 9.59 trillion pounds against 7.91 trillion in revenue, and an average deficit of 21.2%. Now, to put that simply, for every pound the UK government collects, it's spent 1.21 pounds year after year after year. Now, this isn't unique to the UK. Western economies have broadly been running structural deficits for years. But it does bring us to a pretty fundamental question, and that is, how do we fix it? Now, there are really only three levers that a government has in order to be able to close a deficit. The first is to make the country more productive, invest in industry, infrastructure, and technology, grow the economy so that more revenue flows in naturally. Now, this works, but it has long lead times in terms of years, sometimes even decades. The second option is to cut spending, reduce what the government outlays on services, welfare, public sector, wages, but it's politically painful and it's usually unpopular. Rarely do we ever see it done by a government, and rarely do we see it done at scale. And the third option is, well, raise taxes. It's faster to implement, it's got a visible impact on the budget, and let's be honest, governments seem to like it. Now, the UK, like many governments, reportedly has a 10-year investment plan in critical industries. But there's currently no serious appetite to cut spending, which brings us squarely to option number 3. And the debate around which taxes to raise is where it gets genuinely interesting. For example, in the UK context, raising the highest income tax rate from 40 to 41% would generate only an estimated £2.1 billion. Raising the basic rate by 1% would bring in around about £8.2 billion. Now, neither figure is anywhere near enough to close a 30% deficit gap, and both have been described as politically toxic. So in general terms, if income tax hikes aren't the answer, what is? And more importantly, does any of this end up costing you more at the checkout? Okay, here's where I'm going to say something that may be surprising. Raising personal income tax rates on its own does not make the cost of living more expensive. Now, I know how that sounds, but let it sink in. Now, here's the logic. In a progressive income tax system like those used in Australia and the UK and many similar countries, income tax determines how much of your gross pay actually lands in your bank account. Increase the tax rate and your take-home pay goes down. Lower the tax rate and it goes up. But the price of a loaf of bread, the cost of your electricity bill, the rent on your apartment, or maybe the house that you're in, those don't change because of a shift in personal income tax. What does change is your buying power, and that matters enormously. If you've got less money in your pocket, you spend less. And when millions of people across an economy simultaneously spend less, businesses feel it. Sales drop, revenues fall. The circular flow of the consumer economy starts to contract. So while income tax doesn't directly inflate prices, it absolutely constrains your ability to participate in the economy as a whole. And that has its own downstream consequences. But here's where it gets really interesting. Because what happens when we change the taxes that businesses pay? Now let's use a simplified business model to work through this. Imagine a business with 20 million in gross revenue and 20% gross margin. We're going to change one variable at a time, and we're going to have a look at what happens. Now, first up, we're going to have a look at payroll tax. Let's say payroll tax increases from 4.75% up to 10%. Now, immediately, the business's payroll tax bill jumps from, in this case, $71,250 up to $150,000. Now, that's an increase of $78,750. Now, the cascading effect, the net profit drops. The government's share of total revenue increases from 15.3% to 15.6% in this model. Now, here's where the business has to make a decision. Now, option A is to absorb the cost, take the hit to the net profit and maintain its current pricing. This protects consumers in the short term, but businesses care about that bottom line, and in many cases they have to, especially at scale. Option B is pass that on, raise prices to compensate. Now, if the business increases its gross revenue through higher list prices, adding that 78,750 back in, the net profit actually only recovers by about $47,000, not the full amount, because other taxes kick in on the higher revenue. The business would need to increase its gross revenue by approximately 2% just to stay within $1,000 of the original net profit. And here's the kicker. The government actually ends up collecting an additional $119,000 from this business. That's double what the payroll tax increase alone generated. Because when the business raises its prices, all of the other taxes calculated on top of that revenue go up too. So payroll tax increase can make the cost of goods more expensive by about 2% in this case, if a business chooses to compensate. But let's keep going. Next, let's have a look at capital gains tax. And capital gains tax has been in the news recently, so I think this is a good time to actually have a look at it from a business point of view. Let's increase this from 25 to 30%. Now, on this single change, the business ends up paying an additional $196,437 in tax. The profit margin drops from 14.7 down to 13.8. The government's share rises from 15.3 up to 16.2%. Now, compared to payroll tax increase, this is a much more powerful revenue tool for the government. Capital gains tax generates about $137,000 more than the equivalent payroll tax change in this model. But again, businesses can respond. So to fully restore the business's net profit, the business would need to increase its annual pre-tax revenue from 20 million up to 21.4. That's approximately a 7% price increase on its goods or services. A 7% price increase across an entire economy where every business is facing the same capital gains tax hike isn't just inflationary, it's government-initiated inflation. And remember, there's cascading effects here too. Higher prices mean higher GST collected, Higher revenue means higher taxes across other categories. The government collects an additional $420,000 from this one business if it compensates through pricing, compared to just $196,000 from the capital gains tax increase alone. So that's two bites at the same cherry. And now we come to GST, or the goods and services tax, or value added tax as it's known in countries such as UK and in other places across Europe. Now, this one is fascinating because of where it actually sits in the model, because GST is applied to every transaction. In our model, if GST increases from 10 to 15%, the government's GST take goes from 2 million up to 3 million straight away. But here's the interesting part. Technically, the business's net profit margin remains unchanged. GST is collected on behalf of the government and stripped out before the gross profit is calculated. So the business doesn't directly lose money. So does that mean it's harmless? Well, no, absolutely not. The consumer pays that GST every time without exception on any good or service that applies. A 5% increase in GST means every single good or service you buy just got 5% more expensive overnight. That is direct, immediate, across the board inflation for the individual consumer. And then the second order effects kick in. And now we're talking about employees facing higher costs of living, most likely going to be needing higher wages. Higher wages mean businesses face higher payroll costs. Higher payroll means higher payroll tax, and the cycle just compounds from there. To maintain their real purchasing power after a 5% GST increase, an employee would need roughly a 6% increase in gross pay, accounting for the fact that their income tax takes a cut of any raise they receive. So GST, while technically neutral for businesses, is the most direct and immediate tax on the individual. It hits your cost of living the moment it's implemented. So let's bring all of this together. Personal income tax doesn't raise prices, but it reduces your buying power. At scale, that contracts consumer spending and it ripples through the economy. Payroll tax increases can raise the cost of goods by around about 2% in this model if a business responds by lifting its prices. And the government collects even more through the cascading effect. Capital gains tax increases are a bigger hit to business profitability, and if the businesses compensate, we're looking at price increases in the range of around about 7%. That's not inflation, that's government engineered price shock. Whereas GST increases are the most blunt instrument of all, immediate, unavoidable, and felt by every single person in the economy. They inflate costs directly, then they compound through wages and payroll tax. That uncomfortable truth here is that no matter which of these levers a government were to pull, the government wins. The revenue goes up either directly through the tax itself or through the cascade of secondary effects that follow when businesses and individuals respond. The real question isn't whether the government benefits, it simply always does. The question is who absorbs the cost and by how much. And that brings us back to where we started. When a government faces a 30% budget deficit and chooses taxation as its tool, the impact on your cost of living depends entirely on which tax they reach for. Income tax is going to hurt your wallet quietly. Payroll tax adds a few percent at the checkout. Capital gains, potentially a 7% price shock across the economy based on the model that we've just looked at. GST, you're going to feel that immediately, every single time you buy something. Now, the model that we've used here is deliberately simplified. Real economies are vastly more complex, but the directional logic, I think that holds up. And it gives you a framework to think critically every time a government announces a new budget. Don't just ask, are taxes going up? Ask, which taxes, on who, and who really pays for it in the end? Now, if this breakdown was useful, hit subscribe, and I cover economic and financial literacy without the jargon. If you want to go deeper on where government money actually goes once it's collected, we've linked that video above. Thanks for watching. I'll see you in the next one.